All right, so we'll be starting with a new topic today, that is the monetary policy. And this monetary policy is actually the policy of Reserve Bank of India, that is the Central Bank of India. And this monetary policy revolves around the quantity of money. Now, monetary policy is a very important tool in terms of controlling the inflation as well as looking into the overall economic growth in India. Now, considering the kind of status that the Indian economy has, the role of monetary policy is very important, because the fiscal policy, that is the taxation policy of the government, is sometimes very limited to reach the organized sector. So in this case, the role of monetary policy becomes very important. So we'll be starting with monetary policy and what is actually the monetary policy, how it actually works. Then we'll be shifting to the next topic, which is the monetary policy committee. Then we'll be looking into three important policy rates: CRR, SLR, and the repos. So let's start with the monetary policy first and let's understand what is monetary policy all about. Now, monetary policy, the term itself means money, a policy which involves money. Now, what to do with the money, right? What they are going to do with the money. So in this case, they determined that what is going to be the demand and the supply of money, which basically means they are going to determine the overall quantity, right? The overall quantity of money. Now you might think, so what is money? So let's delve a little bit into that as well. See, money basically here means anything which is held by the people. All right, and holding by the people includes the one that you carry in your pocket, that is the currency, the one that you have in the bank accounts as a fixed deposit, as a time deposit, as a saving account, as a current account, the deposits that you have in your post office, right? So all those kind of things which are used for consumption purpose, investment purpose, and many other things involves money. Now in this case, money will not include wealth, right? So if you have a wealth, let's say in terms of gold, in terms of property, so all that is not going to be counted over here. Please remember that. All right. So whenever we are talking about monetary policy, we are talking about the money. Yes, exact money, the currency, the notes, the coins that either I have, you have, or the people have in their bank accounts or in their hand as a currency or as a cash. Now, as far as demand is concerned, so the demand of the money is not in the hand of RBI. Now, demand of money or money demand based on multiple different pointers. For example, your income level. For example, I am a customer, I am a consumer, so I would always demand money. Now, I demand money for multiple purposes. I demand money for consumption. I demand money for precautionary things, right? Precautionary things might include the future, how the future is going to be. So I'm a bit cautious about that. So I might demand money for that. And the third one is I demand money for speculative purposes. Now I'm giving you the 3 pointers from the Keynes side, right? You are for UPSC General Studies. You need not to go deeper into that. But these are the 3 things: consumption, precautionary measures, as well as speculative. All right. So we demand money to put in stock market, to invest somewhere in a risky business, and even sometimes something else also, like gambling and this online games and all those things. So that's a demand of money, and RBI as an institution is very limited in terms of how to control the demand of money. So as far as this concept is concerned, RBI has limited role. So where does RBI comes into the picture? RBI comes into the picture at a place where money is supplied. Yes, how money is being supplied. Now, what is money supply? Now, it is not the supply of money from one person to the other person. Please remember that. It is not a flow of money from one person to the other. That is transactions. That is how the money changes hand. Money supply is actually the total quantity, not quality, total quantity of money. Now, please remember again, whenever I say money, please don't include gold, property, wealth, right? Your iPhone, don't include that. All right. Total quantity of money in an economy. That's it. That's total money available in the economy. So that's it, total quantity. What's the value? Let's say the present total quantity in India, I'm just giving you a hypothetical example, is 1000. Now this can be multiple in the future. In the coming classes, we are going to discuss about the supply of money, the quantity of money, the different measures, M0, M2, M3, M4, right? Those are the different measures which are used to allocate that how this 1000 is determined. Now let's say this 1000 includes currency, bank deposits, right? Post office deposits, and many other things. There are multiple things that we'll be discussing in future. Now, the monetary policy determines the supply of money, that is how this 1000 is going to increase or decrease. Yes. So monetary policy determines what? The overall money supply in the economy. And by that, I mean up or down. Whether the economy should go up in terms of this 1000 or down from this 1000. Now, basically, it is not how RBI determines. RBI will never call you to say कि your bank account interest rate is going to be increased or it is going to be decreased. Now you are happy or you are sad. That's the point. So RBI does not determine that. RBI actually creates changes in the interest rate, basic interest rate, policy interest rates, and multiple other quantitative tools. That is being transmitted to the banks. Banks then transmit it to you. So it is known as monetary policy transmission. Yes, monetary policy transmission. Or monetary policy transition, right? Now from RBI to bank and from bank to customer and gradually to the economy as well. Now, the role of RBI is to change the monetary policy in order to change the overall quantity of money in the economy, and RBI can either increase this quantity or decrease this quantity. Now let's understand this increase and decrease. Let's say I'm assuming that a total amount of money in Indian economy is 1000, right? It is held by X number of people in India. Basically, like these many people have this much of money, currency, bank account, whatever, saving deposit, current account deposit, or time deposit, and multiple things are there. Now the people who are having this 1000 rupee are going to spend this, right? So let's say out of this 1000 rupee, 500 was spent by people on their routine things. They are buying goods, services, merchandise, food, fuel, day-to-day consumption, EMIs, home loan, car loan, and all those things. 500 rupees is being invested. Then let's say 200 is being used by government for multiple purposes. The rest 300 is being used by private sector, let's say corporates, companies, factories, industries. Multiple uses are there. So the same money can be used for multiple purposes. Now, there's an inflation, right? There's an inflation. And inflation comes when demand exceeds supply. In India case I'm taking, in India, it is mostly the demand pull inflation, not the cost push. Mostly it is demand pull inflation. Because India is a high demographic country which has a high demand as well. Sometimes you also have a cost push inflation, but in rare cases, right? For example, especially in the case of fuel, not otherwise. Now there is inflation. To control inflation, inflation means what? People are having more money. So demand is more, right? If people are having more money, so we need to control this or this or this. Now, as I said you, RBI is not going to call you to tell you, please reduce your expenditure. What they'll do is that they will change R. And R here means interest rate. Let's say I want to buy a car and presently the interest rate on car loan is, let's say 8%, right? car loan is 8%. Now in this case, if this is 8%, I can buy a car, I will plan and I will buy it gradually. But what is the other way around? Government and RBI does not want from me to buy this car, because they want to restrict my consumption so that inflation is controlled. So what they'll do is RBI will increase the rate of interest. When they will increase the rate of interest, this increase the rate of interest will gradually transform on my car loan by SBI. This increase was done by RBI, from RBI to SBI, and from SBI to me. Now to me the interest rate is 10%, which is like 2% extra on the existing loan. So I might rethink again, and I might defer my expenditure as of now to buy a new car, right? 100% people will not be discarded, 100% consumption will not be controlled, but at a larger extent it will be. And when we talk about the industries who are taking, the industries which take a loan of 100 crores, 200 crores, 500 crore loans, at that point of time 2% means a lot. All right. So this is how the inflation is controlled. The same reverse thing happen. In the reverse thing, when there is a deflation, prices are falling. Deflation or disinflation, both the thing. Either the inflation is falling or the rate of inflation is falling, doesn't matter. In both the cases, you will find that there is increase in the overall quantity of money. So this 1000 will become 1100. How? The rate will be reduced. So RBI will reduce the rate, 8 will become 6%, and not only me, other people might also start thinking about buying a car. So prices will increase. So from all this discussion, what do we understand so far? We understand that monetary policy has the most important target, which is inflation control. All right. And this is the core area also for RBI. See, RBI have multiple other functions also. They print currency, they manage the foreign exchange, they are bankers to bank, they also supervise and regulate the banking system, right? They also look into some of the NBFCs, like deposit taking NBFCs. So RBI has multiple role, but controlling inflation is one of the role of RBI, in which they control the inflation via monetary policy. Now, previously, this inflation control is also coupled with promoting economic growth, right? Like you might find that sometimes RBI gives subsidy on certain loans, government gives subsidy on certain loans, and the interest rates are reduced, right, intentionally to promote a particular specific sector. So previously, monetary policy was actually decided by multiple quantitative things. They include cash reserve ratio, the first topic that we are going to discuss today. Then statutory liquidity ratio, the second topic that we'll be discussing, and the third one is repurchase agreements and its opposite, reverse repo or reverse repurchase agreement. Now this is also known as popularly repo. All right. So these are the three tools that we are going to discuss about. Other tools are also there, like bank rate is there, which we'll be discussing in the coming classes. So this is how it is. All right. Now, monetary policy is previously determined by RBI governor, and he alone used to decide everything, that what is going to be the repo rate, how is going to be the other policy rates, and so on and so forth. However, this has discontinued now. Now, who is deciding monetary policy? That is the overall quantity of money in the economy. The one who is deciding this is a separate committee known as Monetary Policy Committee, a 6-member committee that determines the policy rates as per the majority phenomena or majority point. We'll be discussing with this as well. Now, why do we need such kind of a change? Why we shifted from RBI governor, a single person, or deciding everything, to a multi-member body? So that government can also have a representation, and there should be less discretion of a single person, right? It's not like a one person body and all those things. See, in these three cases that we are going to discuss today, this is the target of Monetary Policy Committee. These two are still under RBI. So RBI decides on its own, right? This is how monetary policy decides and policy rates are being decided. So let's understand this. And secondly, these two, that is the first two, right? They changes very rarely. Sometimes once in a year, sometimes twice in a year. On the other hand, this might change every 2 months or may continue to be the same. That's the choice of MPC. So let's start with Monetary Policy Committee, the committee which decides repos or the repurchase agreements, and how these repurchase agreement later on changes the overall scenario. Now, previously under Urjit Patel, right, ex-RBI governor, he was the RBI governor when demonetization took place. Now there was a committee under Urjit Patel. This committee suggested that there should be a Monetary Policy Committee consisting of RBI plus government, RBI members plus government representatives, right, or government nominees. Why? They say that this committee should solely focus upon repurchase agreement or repo rates. It should have a statutory powers, it should have a legal powers, and its decisions should be binding on RBI. And if RBI could not meet the decisions taken by this committee, they should within 9 months, if in the 9 months or 3 quarters they could not fulfill the demands or the expectations of the MPC, they should tell the same to the government. All right. So this MPC was created to bring changes in repo rates. Now, repo rates, that is repurchase agreement, will be decided by MPC. Now they say they should meet 4 times in a year, but actually it meets 6 times, right? That is every 2 months, this Monetary Policy Committee. When it comes to the composition of monetary policy includes 3 members from RBI, which are RBI governor, deputy governor of RBI who is in charge of monetary policy, and an official from RBI. Now this official is represented by Central Board of RBI. Now if you are thinking that RBI governor is the sole power of RBI, you are absolutely wrong. See, RBI governor is just the top authority. The exact functioning, the management of RBI is taken by each and specific department under the control of Central Board of RBI. All right. And Central Board of RBI is the most powerful body. Now these 3 members, that is RBI governor, deputy governor, involved in monetary policy, and one of the officials selected by Central Board, these are the 3 members. The other 3 members are government appointee. So there is a committee under the cabinet secretary which appoints 3 members. Now these are the 3 members which are appointed by the government, and they have a good experience in terms of banking, finance, economics, and good experience. Even they could be the professors teaching the economics, so on and so forth. Now these are the 6 members. How do they decide? Now the decisions of Monetary Policy Committee is taken by majority vote. That is, whosoever majority, what's the majority in 6? 4:2. It cannot be 3:3, right? So that's the majority. But what if there's a case of 3:3? 3 people say increase repo, the 3 says don't increase repo rate. What is going to be the condition then? Then this RBI governor will have casting vote. He will vote again. So casting vote is given to RBI, right? RBI governor. That's how it is. So even in, there could be many cases when there is a tie. So RBI governor is going to decide whether to increase repo or to decrease repo. Now the biggest objective of monetary policy committee is, that's the question, right? Ki why we are actually even thinking about creating this kind of a different organization. Okay, Urjit Patel has suggested something and we have created that as well. But what is the biggest objective? The biggest objective is to control inflation. To control inflation is the biggest objective. Other things for RBI are taken separately or taken apart. Control inflation. But when can you control inflation? Until unless you don't have the target. You can control the inflation if it is high or low. Exactly. If you are driving a car and I am saying ki please drive slow, then you will say slow to what? Slow to 100, slow to 80, slow to 60. Basically, you should have a specific quantity or a specific number that determines whether the control should be more or less. Okay. Now, in this case, it is 4% plus minus 2%. Right? 4% is the inflation based on CPI, Consumer Price Index, that we will be discussing later on. Now, based on 4%, if the inflation today is 4% or plus minus 2, that is a range, bearable range. Basically, it is between, so the inflation can be between 2% to 6%. Now, India is a developing country. We have a very high unorganized market and many informalities are there. So getting 2% is really tough for India. Recently, we crossed 6%. And because of that 6%, multiple changes were brought by RBI. Now, if the CPI or the inflation actually crosses 6%, RBI is going to increase the policy rates. That is tight monetary policy. Whenever repo is increased, it means tight monetary policy. That is, they want the loans and the EMIs to be costlier, right? And the reverse, whenever repo rate is reduced, it is going to be loose monetary policy or easy money monetary policy, or you can say easy monetary policy, right? Bearish, bullish, and all those things, those kind of terms are being used for this. Now, coming from that, once they have decided that what is going to be the policy rates, let's say they have decided that the repo rate is going to be 6%. That is, if a bank, a commercial bank, let's say SBI, comes to RBI to take loans, RBI will give the loans at 6%. All right. Now, when RBI offers loan at 6%, obviously, if there's an increase in the repo rate, SBI will increase its EMI or its interest given to the customers. Hence, there will be control over inflation. So, tight monetary policy targets high inflation. Usually, in the last couple of, I would say, not couple of, actually 4-5 quarters, we have seen that RBI was reluctant to bring any changes in repo. But however, they have done a good amount of monetary policy management in the recent 1.5 years. So this is how the entire objective has been taken place. Now the question is this binding? Yes. The suggestions given by MPC is binding on RBI. See, MPC just suggests that keep it 6%, increase, decrease, or keep it same, accommodative, or whatever it can be, right? RBI does the rest. Now, what if they say keep it under 3% or keep it at 4% or 5%, but RBI fails to do that, and RBI fails to do that for next 9 months? In that case, RBI has to give an explanation to the government of India that why they have failed to do that. All right, and government would know that these are the conditions that why RBI has failed to control inflation on its part. If RBI fails, see, monetary policy has an objective of short term, right? Short term ups and short term downs. And when I say short term, means 3 months, 6 months. On the other hand, fiscal policy, it has a longer duration, like 6 months, 1 year, 2 year, 5 year. So mostly government and RBI tries that monetary policy should be the first initiative they take to control inflation. If monetary policy remains very weak, in that case, fiscal policy comes into the picture, right? The policy of taxation. So this is how the entire thing works. Now, before jumping into what is CRR, SLR and repos and details of that, we should understand the basics that we have discussed